For this next topic, we're going to stay closely connected to the concept of cash, but we're going to add one complicating factor: foreign currencies. Modern business is increasingly global. Companies sell products to customers in other countries, they purchase inventory and supplies from foreign vendors, they can even borrow money from international lending markets. And for all examples and problems, we'll be taking the perspective of a U.S. domestic company. And we'll consider two common examples of transactions: export sales and import purchases. There are a couple of things to remember with these types of transactions. First, they might be denominated in a foreign currency. That means a company may transact international business using US dollars. But it's also possible that these will be settled using euros, Japanese yen, British pounds, Canadian dollars, Mexican pesos. Many other types of currencies exist. But second, these often take considerable time to complete. A company might make a sale today, but receive payment 30 days later. Or it might purchase inventory today, but pay the supplier several weeks down the road. And that time gap creates an important accounting issue. When exchange rates change between the transaction and payment date, the US dollar value of the associated receivable or payable is going to change. And these fluctuations in value create real economic gains or losses. Before we can account for these transactions, we need to first better understand exchange rates. An exchange rate is simply the cost of one currency in terms of another. And there are two ways exchange rates may be expressed, using direct and indirect quotes. A direct quote tells us the amount of domestic currency needed to purchase 1 unit of foreign currency. And given our perspective as a domestic US company, we would say that a direct exchange rate tells us the number of US dollars it takes to buy one foreign currency unit. So, to translate some amount of foreign currency into US dollars, we would multiply the amount by the direct quote. An indirect quote works the other way around. It tells us how many units of foreign currency can be purchased with 1 unit of domestic currency. This is probably the way you typically think about exchange rates. How much does $1 US get you in terms of that foreign currency you're interested in? When we have an indirect quote, we're going to divide the foreign currency amount by that rate to translate it into US dollars. I would certainly take note of these arithmetic operators. A critical first step is knowing how to translate foreign currency amounts into our reporting currency. But now let's think about why exchange rates and their changes over time matter. I'm going to introduce this through the concept of transaction exposure. It is one type of foreign exchange risk that exists when there's a time gap between the initiation of a contract and its settlement. Let's illustrate this through an example. Suppose an American company imports goods from a Japanese supplier and agrees to pay in Japanese yen. At the time the contract is agreed upon, the purchase price is 2.7 million yen and the exchange rate is $1 US equaling 150 Japanese yen. So think to yourself, is this a direct quote or an indirect quote? Because this is showing us how much foreign currency can be purchased with one domestic unit, this is an indirect quote. So to translate this into US dollars, we would divide 2.7 million yen by 150, which gives us 18,000. So at the purchase date, the American company has effectively purchased goods with a US dollar value of $18,000. But now suppose that payment is not due until a few weeks later, and by the time payment is made, the exchange rate has changed. Instead of $1 US equaling 150 yen, $1 US now equals only 135. So the same exact 2.7 million yen costs more today in US dollars. We could see this by dividing 2.7 million yen by 135, which now gives us 20,000 US dollars. Now, to be clear, nothing about the inventory itself has changed. The supplier did not increase its price. There's nothing more inherently valuable about these goods, the company still owes exactly 2.7 million yen. But because the exchange rate changed, the US dollar cost increased from $18,000 to $20,000. And that $2,000 difference is going to be recorded as a foreign exchange loss for the American company. The company will end up paying $2,000 more simply due to fluctuations in currency values. Now, I realize some of these concepts can be a little tricky the first time you learn them, so I want to go through each type of transaction one more time and discuss the downside risk that stems from the transaction exposure. Starting with export sales, where does transaction exposure come from? It arises when our international customers pay us in a foreign currency after the sale has been made. And if that's the situation we're dealing with, I want you to think to yourself, what is the potential downside risk? Obviously, it's changes in exchange rates, but what do we worry about when we're going to receive a foreign currency in the future? Specifically, the downside risk is that the foreign currency might depreciate or decline in value between the date of the sale and the date we receive payment. In other words, we've contracted to receive a certain foreign currency amount in the beginning, and that will not change over time. But there is the potential that the foreign currency will be worth less at the time we receive it. Let's go through this again, but now in reverse. What happens when we commit to import purchases? We've got transaction exposure when we, the importer, are required to pay our international suppliers with the foreign currency. And what is it we're worried about? Maybe hit the pause button real quick. See if you can articulate this out loud. What is the downside risk? We are specifically worried that the foreign currency might appreciate in value between the purchase and payment dates. Potentially, it may take even more US dollars converted into a foreign currency to settle that obligation. We'll run through the accounting examples soon, but for now, I want to give an overview of the process for recording the journal entries in connection with these foreign currency transactions. The first step is to record the original sale or purchase in US dollars at the exchange rate on the date of the transaction. So for an export sale, the company records sales revenue and accounts receivable in US dollars based on the exchange rate at the date of sale. For an import purchase, the company will record inventory and accounts payable in US dollars based on the exchange rate at the date of purchase. After that original transaction is recorded, we do not go back and adjust sales revenue or the cost of the goods purchased just because the exchange rates change. The original sale or purchase remains recorded based on the exchange rate at the transaction date. Instead, later changes in the US dollar value of the foreign currency receivable or payable, they are going to be recorded separately as foreign exchange gains or losses. This is important because the gain or loss did not come from selling more products, charging a higher price, buying better inventory, or negotiating different purchase prices. It came from the movement in exchange rates, which is entirely outside of the company's control. So accounting separates that effect from the operating transaction itself. The related receivable or payable needs to be updated. If the company still has a foreign currency receivable or payable at the end of the reporting period, it must adjust that account to reflect the current exchange rate, and that update will be made through an adjusting entry. So to wrap up, foreign currency transactions matter because international business often involves both foreign currencies and time gaps. When payment does not happen immediately, exchange rates can change before the transaction is settled. And now you've seen how accounting captures these changes by adjusting receivables and payables and recognizing foreign exchange gains or losses separately from the original sale or purchase.